Toys R Us filed for Chapter 11 bankruptcy in September 2017, citing roughly $5 billion in debt that its operating cash flows could no longer service amid intense competition from Amazon and other e-commerce players that had transformed the toy retail landscape. The bankruptcy created an unusual institutional dynamic for Vornado Realty Trust, one of America's largest REITs. Vornado had co-invested in the 2005 Toys R Us leveraged buyout, alongside Kohlberg Kravis Roberts, KKR, and Bain Capital in a $6.6 billion transaction. Its role was specifically designed to bring real estate expertise and asset management capabilities that the private equity firm's standard model lacked. Vornado's contribution included acquiring fee ownership of a significant portion of Toys R Us store real estate and leasing it back to the retailer. Rents were set based on projections assuming the pre-Amazon competitive environment would persist, with the properties expected to generate stable income tied to the retailer's ongoing performance. When Toys R Us filed for bankruptcy, Vornado found itself in two conflicting positions simultaneously: as a private equity co-investor whose equity stake was wiped out, and as a commercial landlord whose lease income stream from the same retailer was severely disrupted. REIT and retailer entanglement. The forensic entry point of this case is the complex relationship between a REIT's ownership of leases underpinning a retailer's store network and the direct impact of that retailer's bankruptcy on the REIT's real estate portfolio. The Toys R Us episode highlights the risk when a REIT integrates into a leveraged buyout consortium. The retail business's failure disrupts the very locations whose lease income supports the REIT's asset values. The REIT owned the real estate. The retailer owned the bankruptcy. Both realities applied to the same portfolio of store locations. This structure exposed Vornado to risks that a pure real estate investment mandate had not fully anticipated. If this is your first case file from this channel, subscribe now. Every episode adds another layer to understanding the architecture of institutional failure. The $6.6 billion 2005 buyout ultimately led to a $5 billion bankruptcy and a major retail real estate management challenge. The merger of private equity financial engineering and REIT real estate strategy had not adequately prepared for this combined outcome. The 2005 leveraged buyout reflected mid-2000s market conditions, abundant cheap debt, and a rationale centered on real estate portfolio optimization. These deals assumed retail market conditions would remain stable enough for projected cash flows to service high leverage. Amazon's rapid rise in the toy category fundamentally altered that assumption. The acquisition was financed with approximately $5 billion in debt. Leverage levels were calibrated to mid-2000s operating projections that did not account for e-commerce disruption. As Amazon captured growing market share over the following decade, Toys R Us experienced declining comparable store sales and compressed margins at a pace the financing structure never realistically modeled. The critical, unpriced covenant was the linkage between heavy debt service and the cash flow capacity of a toy retailer facing structural disruption. Vornado's lease income became particularly vulnerable. As landlord, its revenue depended on a retailer confronting the most transformative competitive threat in modern American retail history. Vornado's dual role created an inherent structural conflict. A REIT's mandate is to own and manage income-generating real estate assets. A retail LBO's mandate is to drive returns through operational changes and financial optimization. When the retailer entered bankruptcy, these mandates clashed irreconcilably through conventional portfolio tools. At what point does a REIT's co-investment in a retail leveraged buyout create a fundamental conflict between its core real estate mandate and exposure to the retailer's competitive risks? Share your analysis in the comments. Conventional wisdom suggested compatibility. Real estate ownership would provide a value floor even if the operating business failed. The Toys R Us case tested this assumption. Many stores were purpose-built for a specific large-format toy retail model. The bankruptcy eliminated the primary tenant and use case, triggering a value collapse similar to the purpose-built asset failures documented elsewhere in this archive, such as the Silverdome case scaled across a national suburban retail footprint. Bankruptcy impact and repositioning challenges. Vornado faced the challenges typical of a major commercial landlord when its largest tenant becomes a Chapter 11 debtor, aggressively shedding locations. The Toys R Us reorganization ultimately led to full liquidation in 2018 rather than emergence as a going concern. Vornado was left with dozens of vacant or underperforming retail properties in a market already reeling from broader e-commerce disruption. Repositioning proved difficult. Toys R Us stores were large standalone or strip center formats optimized for toy inventory and family shopping experiences. Alternative tenants required substantial renovations, and demand for such spaces was limited amid industry-wide shifts. The institutional denial here mirrors patterns in prior cases, such as the Campo retail acquisition, case file 060X, and the SNL crisis, case file 056. Real estate expertise and capital were deployed in a retail operating company under the belief that superior property management would mitigate competitive risks. In reality, high-quality real estate assets could not shield the core business from Amazon's disruption. The real estate expertise was genuine. The competitive vulnerability was equally real. The $6.6 billion buyout followed by $5 billion bankruptcy demonstrated that one did not meaningfully offset the other. The real estate floor proved dependent on the retailer's continued operation at scale. When that operation collapsed, so did much of the supporting lease value. Vornado's overall financial outcome, equity losses from the bankruptcy plus repositioning costs and lost income, illustrated the tangible consequences of this structural conflict. The Toys R Us brand saw a limited revival in 2019 under new investors, operating with a much smaller physical footprint. This reflects a recurring theme. Strong brand recognition can persist after financial failure, but restoring pre-bankruptcy physical retail scale is often impossible. Lessons from the archive. Within this channel's 84-case archive, the Vornado Toys R Us case highlights the specific institutional risks when a REIT's portfolio becomes intertwined with a leveraged retail acquisition. Combining REIT real estate management capabilities with private equity, financial engineering does not insulate the real estate value floor. Purpose-built retail properties lose primary utility when the format they serve fails competitively. This case connects to the Robert Campo saga, where real estate-oriented financial frameworks were misapplied to retail operations, and to the SNL crisis, where institutional real estate capital faced mismatched risk profiles in speculative ventures. The REIT owned the leases. The retailer owned the bankruptcy. Post-bankruptcy, those leases were worth substantially less, not because the underlying real estate physically deteriorated, but because the operating business that gave them primary value had disappeared. If this case file has shifted how you view the integration of REIT portfolios with retail leveraged buyouts, subscribe. The next episode examines another REIT's exit from a different retail relationship. Given Vornado's simultaneous equity loss and lease income disruption from the Toys R Us bankruptcy, what transaction structure could most effectively have separated the REIT's real estate mandate from the retailer's competitive exposure during the 2005 buyout? This content was developed using artificial intelligence tools as part of the research, writing, and production process. All AI-generated material was subject to human review, editorial intervention, and approval before publication.